Welcome, everybody. Thank you for spending some time with us today to discuss this very important topic on charitable giving. And now, some prefacing remarks. The conversation is not about convincing clients to give away more of their wealth. The conversation is focused around the idea of providing advice on how to make our charitable giving more effective, both for the donor and for the recipient organization. Over 87% of wealthy families suggest that they would like some help, guidance, or education around their charitable giving activities. But for the majority of them, they're not having this conversation with their advisors. We hope that today's primer allows you to facilitate those conversations in a more productive manner. So here's what we plan on covering today. We're going to talk a little bit about what to give, when to give it, and how to give to make this giving more impactful, both for the donor and for the recipient organizations. When it comes to what to give, there are a couple of different variables that determine the tax benefit that we might derive. Number one, the entity that receives the gift, whether it's a public charity, like most donor-advised funds and large nonprofit organizations, or a private foundation that a few wealthy families may establish during their lives. But the key driver of the tax benefit is the type of property that's used to fulfill this charitable gift. Let's focus on two examples. Specifically cash, which is a really convenient way to give, where we receive a fair market value deduction, capped at 60% of our adjusted gross income in a single calendar year. The second type of property that is often given is long-term capital gain property. Think about stocks, bonds, and other securities, where the deduction, once again, is the fair market value of the property given with a 30% cap, maximum of AGI, deductible in a single calendar year. Any gift that exceeds those limitations, by the way, can be carried forward for 5 years. When we talk about what to give, it's often suggested that giving appreciated property provides an even greater benefit than giving of cash. Here's a quick illustration to demonstrate that point. Let's assume that our client holds property that's currently worth $100,000, and the original cost basis was $20,000. If the client sold the property, they'd have a realized capital gain of $80,000 and an associated capital gain tax of just over $19,000. This would allow them to contribute about $80,000 to their intended charity, and the value of the deduction at 37% would slightly exceed $30,000. But what if this client were advised instead to give the appreciated property as opposed to liquidating it and giving the resulting proceeds? We can see, of course, the $100,000 capital asset today with a $20,000 cost basis, because it's not sold, would result in no capital gain taxes paid. And the charitable contribution would be the full $100,000 fair market value, producing a deduction worth over $37,000 to the client. We refer to this as a win-win. The charity receives more, and of course, the individual investor derives an even greater tax benefit. When it comes to the idea of when to give, let's do a quick little review of tax rates to illustrate this concept that giving, while we're in a higher bracket, produces a greater tax benefit to the donor. We know the tax rates here are progressive, starting at 10%, and the maximum marginal tax bracket today is 37% for families with income levels of around $700,000. For those individuals who may find themselves in the AMT, a much lesser percentage of the tax-paying population, it's important to note that the maximum AMT tax rate is 28%. Now, we know that the standard deduction today is significantly higher than it's been in past years. That number is $27,700 for the year 2023. Alternatively, clients, of course, have the opportunity to itemize their deductions if that total figure exceeds the standard number. The four primary itemized deductions are medical expenses, assuming they exceed 7.5% of AGI, SALT taxes, which are capped at $10,000, mortgage interest, if our clients do retain a mortgage, and of course, the charitable gift, which can be a real needle mover in the concept of accelerating or increasing our itemized deductions. So with this as background, how do we think about the best time, the most advantageous opportunities as to when we complete our charitable giving? Well, clearly, given the fact that charitable gifts are an itemized deduction, we want to encourage our clients to give when they are itemizing. as opposed to claiming the standard deduction. Clearly, clients derive a greater benefit given the higher marginal rates under the regular code, as opposed to giving when they're subject to the alternative minimum tax. How about clients who are self-employed, who might be able to take advantage of the 199A deduction? An increase in their charitable activities may result in a lessening of their adjusted gross income and a greater deduction that would be available to them. And then broadly speaking, clients derive an even greater tax benefit when they give in years in which their marginal rate is highest. So let's think about clients who are currently working prior to their retirement, which may see a decline in their income and their marginal brackets. Clients who maybe realized a large capital gain during the year, looking to offset that associated tax bite. Clients who might be considering a Roth conversion, which of course implies the recognition of additional income on that converted amount. They can offset that with a significant or larger charitable contribution in that particular year. And then maybe our clients who are employed by publicly traded companies, maybe the C-suite individual, who holds restricted stock or options, which often produce taxable income to the employee. We've got a great illustration to confirm the benefit of an important giving concept. It's known as bunching, giving a larger amount in a single calendar year as opposed to making smaller or lesser gifts over multiple years. A client who makes a pledge to give $25,000 a year to their intended charity. This client has, in our hypothetical example, $10,000 of state and local taxes, which are available to them, of course, as an itemized deduction. Given the $25,000 annual gift over each of the 4 years in our illustration, this client would have itemized deductions of $35,000, slightly exceeding the standard amount. In aggregate, over this 4-year illustration, the client would receive itemized deductions of $140,000. But what about the client who receives the advice of bunching their gift in a single calendar year? The same $100,000 given to their intended charity, but given in a single year for an incremental tax benefit. Let's examine the numbers. This client has the same $10,000 state and local tax deduction and gives the full $100,000, either directly to their charity or maybe through a donor-advised fund, and then makes distribution over the next 4 years. The aggregate itemized deductions in the first year would be $110,000, providing a significant deduction to our client. And in the resulting 3 years, given the fact that there's no charitable giving taking place, our client relies on the higher standard deduction in those following 3 years. The aggregate deduction in our illustration is over $190,000, providing an incremental benefit of an additional $53,000 of deduction for the same amount of property or assets being given to their intended charities. The question is, how do I give, John? There are so many different ways in which I can fulfill my charitable giving. Of course, the most convenient way is by giving cash or swiping a credit card. We may look at certain philanthropic structures like donor-advised funds or community foundations. Split interest vehicles provide a charitable benefit and maybe an income stream to the donor who's making this gift. And of course, private foundations are a little bit more tedious in terms of their establishment, but may provide a family with additional control and flexibility for their intended giving. These are the kinds of structures that should be considered as we advise our clients on the most effective way to complete their charitable giving activities. And so in conclusion, we'd like to leave you with a couple of conversation starters that may allow you to broach this subject with your clients. How much do you decide to give in a particular calendar year? What are your primary motivations for the charitable giving that you're currently involved with? Why do you choose the certain types of entities or organizations who receive the benefit of your philanthropy? How has your charitable giving impacted your relationship with these organizations, and how have you chosen to get your family involved in the philanthropic activities that you're currently engaged in? I believe that advisors can provide great value to their clients, once again to derive an even greater benefit from the charitable giving that they're involved with. To learn more about this particular subject, please feel free to visit us at PIMCO.com or to contact your local PIMCO account manager. Thank you for joining us today.